Good afternoon, everyone. Today is Friday, the 10th of August, 2012, and this is Brian Shannon from AlphaTrends.net speaking. Let's take a look at these markets here. We had a pretty impressive week. We had a gap earlier in the week, and we held on to those gains really well. The S&P 500 was up 1%, Nasdaq up about 2%. Russell was down a little bit today and closed just below that 80 level, but I don't think that's a real reason for concern. Overall, though, we had a really impressive week for these markets. The S&P 500, as you can see here, we still have this pattern of higher highs and higher lows. Now you got to look at it and say, where does it come from? Where does it have the potential to go before it's likely to encounter resistance? And really, is it best to buy after one of these types of moves, or is it best to kind of wait a little bit? Well, that depends on your risk tolerance. And when we take a look at intraday time frames, we can still see that the market is innocent till proven guilty. We had that gap higher last week, added those gains a little bit on Monday and Tuesday, and we've had three pretty boring sessions, but we've done so with this market above this rising 5-day moving average. We gapped a little bit lower today, but it recovered very nicely, and the SPY here, the spiders that is, recovered and got back above the VWAP and pretty much held above the volume weighted average price for the entire session. For the week, you can see the average price was about 140.35. That's the volume weighted average price for the week, and we are showing that we have a little bit of resistance up ahead, just at about 141. But I think as long as this level of support continues to hold near about 139.5 is what we should really call it, 139.60, that the market remains innocent till proven guilty. Now, we had sideways action. A lot of times sideways action precedes a breakdown, but this time, obviously, so far at least, that hasn't occurred. We've had sideways digestion through time. That is, rather than a strong price correction that might have unfolded kind of something like this, and that 5-day moving average would have started to decline, and perhaps we would have seen a little bit further pullback. That's what a price decline or pullback would have. Price correction would have looked like, and we're not seeing it. We're seeing that the market has important support below it. We're stair-stepping higher, and we're coming into really pretty close to the highs for the year, up near about 142. In fact, if you take a look at the OEX, which is the S&P 100, the 100 often leads the S&P 500. You can see it's right up against those highs. So I think that it's likely we will continue to move higher, but again, if we start to break below, really in particular about 139.60, and then we stay below that 5-day moving average, then I think that the chances of a price correction would grow a little bit here. I wouldn't expect it to turn into anything major, but it would be a correction that we would want to sidestep if we were swing trading. And the Nasdaq was up impressively as well this week. As we know, we had broken that 65 level late last week rather, and we came up and closed this gap as well. Now we're kind of battling with this next area of potential supply where we've had previous support up on the at about the 67.5 level. Looking at the weekly chart, we can see it's really quite bullish looking, as is the S&P 500, that we are up near these multi-year highs and have to go back to really 2008 to see these levels once again. So very impressive. The Russell 2000 does continue to underperform a bit. Once again, if we take a look at, well, this is brought to you by Realtek, by the way. This is Realtek.com. We're looking at their charts. This is all the analysis and trading that I use, and there's tons of tools here that I'm not showing you on Realtek, but I would encourage you to take a look at them. Anyways, the Russell 2000 was up 1.6% for the week, and we did get above that 80 level. In fact, what we had been discussing the last couple of weeks was this pattern of lower highs and lower lows. And earlier in the week, I said what we wanted to see was 80 break, and maybe we kind of hold near there or even pull back. I was thinking maybe we would pull back down towards that 10-day moving average near about 79. Well, we continue to hold up fairly well in here, and we held the lows for the week today. The lows for the week were actually on Monday here. So I think about 79, and this is really, if we break below today's low about 79.5, it will give us reason for caution. So don't think it's just all bullish here, because we have the potential that if we break these support levels, then perhaps we'll see a little bit deeper pullback. However, looking at the daily time frame, what we can see in here, and perhaps we can see it a little bit more clearly on the weekly, is what looks like an inverted head and shoulders pattern with this neckline. So I think actually the daily time frame is clearer to see this shoulder, the head, and then the right shoulder. And actually when we drill down and take a look at this right shoulder, looking at a 30, or let's take a look at the 65-minute time frame, we kind of see the same thing in here. Little shoulder, well, that might be calling too much and reading too much into it. The fact is, though, we do remain above some important support at about 79 to 79.50. This level here, this is good to see the digestion just underneath these highs. And if we continue to hold up, that is, we don't break below 79, 79.50 and stay below there, then I think that this market has the potential to actually lead this market and catch up a little bit and head up towards first about 83 or so, and 82 and a half-ish, and then up towards that 84 level. As we can see, for the year to date, we're only up 8% in the Russell 2000, and a lot of that has to do with some of these stocks like CMG that have gotten hit real hard, and CMG not advancing. We saw Priceline also get hit real hard today, and people who've been trying to buy these on sale are realizing that they're just not easy purchases to buy. Just like Monster.com, which got hit hard on earnings on Thursday, continued much lower again today and really hurt those people that thought they were bargain hunting at about that 61 level. So let these things settle down before you attempt to go near them. As we've seen with so many stocks, when they gap down like this with earnings and then we're below key moving averages, and the 50-day moving average is declining, a lot of times it's going to take a lot to recover from that. So the good news is we have leadership from the semiconductors once again. This level that we were looking at that was prior band of support back in the first half of the year, and then became a little bit of resistance this year between 32.75 to or 32.80 to 33.10. This was where we were expecting that it was likely that this rally would run out of breath, and it didn't, though. It continued to move higher. A lot of people were looking at this market when it was 32 and a quarter, 32 and a half, and saying there's resistance at 33, and they were trying to sell it short. The fact is, as I always say, we only know resistance after the fact. Until it goes up there and actually turns lower, we can't call it anything but the potential for resistance, an area where it's likely to be found. As I said on a webinar on Monday, technical analysis a lot of time gets criticism as being like forecasting the weather, that people expect it to be perfect. The fact is, what we're looking for is probabilities, likelihoods, and trying to plan a little bit better. We're trying to plan the quality of our day by looking at the weather and what's the risk reward. If the forecast is calling for 20% chance of rain, are you going to be looking to bring your umbrella to work, or is your risk reward better or more matched to your personality that you're going to take a chance unless it's 50% chance of rain? If it's an 80% chance of rain and you're going to be walking through the streets, then obviously if you don't take your umbrella, you're taking too much risk relative to the chance for reward. Now, same thing with the stock market. What we're looking for is probability. It seemed likely, probable, that it would slow down in this area, but the fact is, the reason why we say we want to look for it as potential resistance, but we don't want to use that as a reason to sell short. Just like if there's a 20% or 50% chance of rain, we're not going to walk around with our rain gear, our umbrella opened. We don't want to, we want to wait for it to actually rain. Very similar, we don't want to short just because it's at this potential level of resistance. We want to see a pattern of lower highs and lower lows before we decide that we're going to get short. We don't want to sell short as the pattern of higher highs and higher lows is still existence. It would just be stupid, just like you would laugh at anyone who's walking around the streets with their umbrella open on a sunny day, unless maybe they're shading themselves. But anyway, you get my point. Financials held up really well also. They're battling this $15 level. That's the expected area where they were going to find a little bit of resistance. But we're in this band of prior resistance, which became support, and then resistance once again. And here it is acting as support. We've got a rising 10, 20, and 50-day moving average, and it appears as though the buyers have control and are likely to push it back up to about 15 and a quarter initially. On the 10-minute time frame, we can see that we held some important support here at about 1485 today, really down to 1480. I wouldn't think there's real trouble unless we got below and held below 1480. So we're innocent till proven guilty unless we break below $14.80. Shorter term, we have this little pattern really of lower highs and lower lows over the last 3 days, but it's holding up very well right at that 5-day moving average, and there's no danger really until it breaks below 1485. There's no storm clouds here. There's just the potential for the storm clouds. If those storm clouds come, a lot of people look to gold. Gold is still not in a bullish trend here. It's maybe recovering a little bit. We've got a declining 100, 150, and 200-day moving average. So that makes it a tough environment for gold to rally or anything to rally, but it's holding in this tight range and really above 158 and a half, 159. If it gets above there, then we could maybe see a short squeeze in gold, but bonds did continue lower this week. I was talking about the support at the 50-day moving average. And again, it doesn't mean you buy at the 50-day moving average. It broke that, and we came down and tested this prior support here. Now, bonds have obviously been hurt pretty badly this week, and you can see that in the inverse chart, which is the yield. We still have a declining 50-day moving average, though, so I think that the yields are going to head back down towards about 1560. That would put the TLT back up towards probably about 128, and it's possibly transitioning lower, but again, the longer term trend still is quite bullish on the weekly chart. We've got this bigger level of prior resistance from late last year and early this year, which has held as support so far this year. So a couple other stocks we want to take a look at. Apple really held up well. It's one of the stocks that's really performed. We've been, it hasn't done anything for the last two quarters. As we know, we retook that volume weighted average price here about 2.5 weeks ago from the report two quarters ago, rather, about 4 months. And we're holding up. We've broken this level of resistance, and this market, Apple has held up really remarkably well in here. I wouldn't think there's probably much danger in the stock unless it was to break below maybe about 615 or so. Otherwise, it looks like it's on track to be able to continue higher. Citigroup, and some of these other financials, they're holding in a tight range. We got involved earlier in the week as they broke out, and here they're just holding on, correcting through time. We do have these lower highs and lower lows, but it's really starting to show that it's holding on to these gains, and perhaps something like Citicorp is going to make it up towards its 200-day moving average at $30 a share. A lot of people are also interested in LinkedIn right now. LinkedIn reported earnings, and they gapped higher. They've corrected somewhat since then, and you look at it, and it was up on real big volume. The relative volume on the pullback was much lighter, so that's what we look to see. However, the volume weighted average price since the event, that is since the earnings, let's take a look at that together here. It's already drawn in, but this is the volume weighted average price line, so we can take a look at it since that gap higher on earnings. The volume weighted average price is pretty much tied with that declining 5-day moving average at about 107.35. And if we take a look at the action of the last few days, we have a very distinctive pattern here of lower highs and lower lows. So anyone who's still buying here is anticipating a little bit. Next week, however, I think that LinkedIn could be the type of stock that we get a couple more days of sideways, get back above the 5-day moving average in this maybe 110, I'm sorry, not 110, but 107 and a half-ish area. That LinkedIn could be the type of stock that continues to move higher and breaks out to new highs. So hope this video was helpful to you. Have a good weekend, and check back to alphatrends.net for more. Thanks.